Dan, thank you so much for joining us. It's so great to have you here.
Thank you for having me.
And thank you for having us. It's an absolutely beautiful event.
Thank you for joining us. It's so nice to be back in person doing these things interactively.
It is nice to be back in person. So this event, as you say, brings together seasoned leaders and emerging entrepreneurs. You've got David Solomon, your CEO, is speaking. LL Cool J will be speaking.
I'm interviewing LL.
You're interviewing LL. Former President George Bush.
Yeah.
Goldman hosts many exclusive events. What is it about builders and innovators that you want people to take away from this one in particular?
Sure. Well, this is a great conference. We love it. We may be a little bit biased in that assessment, but it's a great conference and we love it. And it's unique to us because this is a conference that really is designed to celebrate, to promote, to foster entrepreneurship and innovation. As you noted, we do dozens of conferences every year, and they tend to be aligned around industries, and you've probably been to some of them, our healthcare conference or internet conference, software conference. This is different in that it's industry agnostic, it's size of company agnostic, and it's just designed to get 100 or so private company founders and CEOs together to talk about the common issues, the common challenges of building a business and best practices around building a business and to build their own networks with each other. And the energy you get when you bring together that group of entrepreneurs in a setting like this for 2 days to talk about those topics is fantastic. I hope and expect you'll get a sense of that today.
You've worked at Goldman since 1992.
That's right.
Travel the world.
Yep.
How has Goldman's approach to tech investing and scouting earlier stage companies in particular changed in that time?
It's changed quite a bit as the whole technology landscape has changed quite a bit. I look back before my time. I've been here forever, as you said, but before my time, we took Microsoft public back in the 80s when it was a $350 million company. I mean, it's kind of amazing to think about the long heritage of what we've done in the technology space. But what changed probably 15 years ago, 10 or 15 years ago, in our approach to the business was we realized these companies were starting small and getting big very, very fast. And we had to go earlier and earlier into their life cycle to start building relationships because you wanted to be there when they were small and when they quickly grew. And their needs to raise capital and to merge with other companies accelerated up their life cycle too. And so 1 or 2 or 3 years after founding, we were finding these companies were important companies to us and to our franchise. And so we started doing things like this, throwing conferences for earlier stage companies, and we just started building relationships earlier, working with the VCs and finding our ways out in the communities to meet these companies earlier.
Are there any trends in particular that you're doubling down on and trends you're staying away from, or is it more about the people than the idea?
We're doubling down on everything in technology right now. It's such an exciting time. What an exciting time to be in our business, whether it's to be a journalist to the technology industry or a banker. It's an extraordinary time. We're doubling down on everything. Sure, there are a bunch of trends that are very exciting, and some of them are represented here. All the cutting edge technologies, the companies that will deliver us our future, artificial intelligence companies, augmented reality, quantum compute, synthetic biology, all the things you hear about that are cutting edge technologies, those are exciting to double down on, and we're doing that. But equally, when I think about the activity levels at Goldman, and when I think about the activity levels more broadly in the economy, and when I think about the attendee list at a conference like this, one of the places you're really seeing a lot of the opportunity and seeing a lot of things happening is in the places of overlap between technology industry and traditional industries. So financial services and tech, fintech that everyone talks about, auto tech, industrial tech, real estate tech, healthcare tech. And that's really where a lot of the excitement is and where a lot of the activity is happening. And we, both in these conferences and in our business, are trying to treat technology the way the economy treats technology, which is having it be pervasive in all of our groups and infiltrate every group.
Now, one of the talking points of the year has been the trend toward SPACs, toward direct listings. There are some very vocal venture capitalists in Silicon Valley who think deals are the way to go.
Yep.
How do you see the balance in listings shifting? Do you see it shifting away from IPOs, traditional IPOs, or not? And what does that mean for Goldman, especially since sometimes the decision involves trying to not pay fees?
I think all the innovation in the process of taking companies from private status to public listing is fantastic. And we've been at the forefront of that innovation. We continue to push that innovation. And from our perspective, from a Goldman Sachs specific perspective, the aspiration that we have when we talk to these companies at a conference like this is to be able to go to them and say, here are all the tools in your toolkit, all the different ways to get public. There's direct listings, there's SPACs, there's IPOs, traditional IPOs, there's different ways to do price discovery. And we're credentialed in each of them, we have a lot of experience in each of them. Here are the pros and cons and what fits your objectives. And to be able to have that broader slate of tools to go to clients with, I think is fantastic. Again, I've been in this business, as you noted, 29 and a half years, but who's counting? I'm counting. I've been involved all throughout that time in helping to bring companies to market. And it's been fascinating over time to watch as what it means to be private has changed and the process to get public has changed. And so when I first started long ago, especially for tech companies, private status, you were very small, you were very illiquid, you were known and seen to a small number of VCs, and then you would run the gauntlet and go off the step function and suddenly bright lights of public listing. And now that curve has smoothed a little bit. It's a spectrum of being private. You can now get very big, there's a lot of liquidity, you're oftentimes held by crossover investors, and the process of then getting from that status to public has fundamentally changed, and I think in a really good way.
So do you think we'll see more direct listings, or will they continue to be more one-offs?
They're certainly not one-offs. We've been involved in a number of them. They're still the minority of the things. More companies are still choosing the traditional path of a traditional IPO. We continue to innovate on the traditional IPO and find new ways to do price discovery around
because there are folks who say that traditional path is broken.
Yeah, and I don't believe the traditional path is broken. I think the direct listing path is fantastic for a number of issuers. We've done it, and they've gone extremely well, including the one we just did for Warby Parker and Coinbase and others. I think some SPACs, in certain instances, can be really elegant mechanisms to help get companies public, but equally, I think the traditional IPO, you talk to the companies who've been through it, many of them feel great about it, and feel great about their experience and their process of picking their shareholders and picking their price and launching into the public market. So I don't see that as fundamentally changing.
So what is your outlook for the future of investment banking and Goldman's role in it, given coming out of a pandemic, hopefully, and what's happening with inflation and your sort of general market outlook?
Boy, it's an incredibly robust time right now. I won't talk about our specific near-term performance because we're announcing earnings on Friday, but what an extraordinary time to be in this business. And it feels to me like the trends that have underpinned that strength of our business, and you saw our first half results, which were record results and by a lot over any period in time, and we've gone through some big ups and downs in this industry over time. It's an indication of just how robust things are. You know, all of our activity at Goldman Sachs, our investment banking activity, is simply a reflection of the ambitions of our clients. If our clients are growing, forming new companies, needing to raise capital to drive that growth, have strategic ambitions, that's what drives our activity, and it's at very, very high levels. Now going forward, my view is it's going to remain robust. Of course, it can go up and down in any given quarter, and so this isn't a projection, but for the industry at large, to me there are three main underpinnings that are really leading to a lot of activity. One is just the new company formation, all of this that we're seeing here, all of the disruption of traditional industries that needs to be financed and the like. That doesn't feel like it's slowing down, it feels like it's accelerating. The second is coming out of the pandemic, I feel like CEOs and boards had an opportunity to pause, to look at what they went through, to see the way their industries are changing, and to think through the benefits of more scale, to think through the benefit of carving off non-core assets, to think through the benefits of pulling more technology into their business faster, and all of that leads to strategic activity. Then the third kind of buttressing of our opportunity is the amount of capital the financial sponsors have right now, which is enormous and growing by the day, and as financial sponsors put that to work, that obviously leads to a great underpinning for investment banks.
We seem to be seeing increasing regulatory scrutiny around the world. What does that mean for deals, especially mega deals? Will we see less of them?
I don't know, regulatory scrutiny is increasing, and the tone is definitely, the tone is pretty clear out of regulatory bodies all around the world. Regulatory considerations were always part of the M&A process, and we always had to take that into consideration as we advised companies. You have to think through the way you draw up contracts and the way, the types of transactions that might make sense in this regulatory environment. But equally, again, when you just look at the opportunity, in a regulatory environment that wants to be very pro-competitive and make sure there is plenty of this, of a vibrant, competitive ecosystem of companies, there are a lot of M&A deals of smaller companies that come together to be better competitors to the bigger companies, or a medium company that buys a small company to be better competitors to the bigger platform companies. So there is still an enormous amount of space for a very robust M&A environment. And it's been borne out by the numbers recently in terms of what you've seen on announced deal volume.
The Zoom 5.9 deal, I know Goldman was involved in that, didn't happen.
Yep.
Why didn't it happen, and are we going to see more deals, big deals, potentially die like that?
I don't want to talk about any specific transactions, but will we see more deals die? Yeah, I do think you'll see more deals that get the scrutiny, that come together because they believe in the strategic rationale of coming together, and then for whatever reason, whether it's regulatory scrutiny, and this is not a Zoom 5.9 comment, but more broadly about deals coming under pressure, you will see some. We had the Willis Aon Towers deal from earlier in the year get turned down by regulators. And so you will see some of that. And yet equally, again, the offset to that, just the underpinning, robust nature of what our clients' ambitions are, is helping to offset some of that pushback.
I know you spent time in China, and we're also seeing a regulatory crackdown in China. How do you think that will play out, and what does it mean for U.S. investors in the country?
The regulatory pressures in China, it's been fascinating to watch. You also spent time in China, and so we've talked a little bit about this. In some ways, it's not necessarily always different from what we're seeing everywhere else in the world in terms of direction, but sometimes the pace and the clarity of communication and the dictate that comes leads to faster action and faster changes and faster rebalancings in some of the industries that they are targeting. But we'll see. Again, in China, when I talk to our bankers over there, the underlying level of innovation and creativity and new company formation and optimism, it's easy for us to look over there and say, oh boy, it seems like a pretty tough environment from a tech perspective. The underlying momentum in that business remains extraordinarily high.
Okay. I want to talk about talent. Wells Fargo just came out with a report saying that 100,000 banking jobs will disappear in 5 years to be replaced by technology. Do you agree or disagree?
I didn't know there were 100,000 banking jobs out there. I'm intrigued. I don't know if I didn't read the report. I don't know if they're talking about investment banking. I can't imagine.
They say developers are the new bankers.
Yeah. So look, I think it's a fair discussion, and I think it's an interesting thing to talk about. And we're very clear-eyed and vigilant about the potential for technology to disrupt our industry. I mean, it would be quite short-sighted of us to be the #1 investment bank for technology companies and to be taking all these companies public that are disrupting traditional industry, and to not also think about what could developers do and innovation do to our industry. And so we do spend a lot of time thinking about it. Having said that, when I've got a co-head, Jim Esposito, and we spend a lot of time thinking through this. We think about, and I think it's probably how every industry thinks about this, we think about what part of what we do is human heavy, human capital heavy, human value add heavy, and what part is automatable. Is that a word? Is prone to automation. And the stuff that we do happens to be the vast majority of what we do. Build long-term relationships, give advice, craft equity stories, tell equity stories, structure complex deals, negotiate. That's human heavy stuff, and we need more and more people to do it given the current pace of business. On the other side, we embrace the innovation coming from developers to try to automate more and more stuff. We have dozens, if not 100+ automation projects going on in investment banking, because our aspiration would be for all of our people, from our most senior to our most junior, let's find ways to reduce the mix of the menial stuff that needs to get done and increase the mix of the meaningful stuff that needs to get done, and that's our push. So we're rooting for the developers in many respects to come and disrupt certain aspects of the business, and yet we're still pretty confident that the human part of our business will be important.
There's a war for talent, especially a war for tech talent.
Yes.
Goldman has taken a pretty firm line on employees coming back to the office. Tech companies are being more flexible, some banks are being more flexible. Are you at all concerned about losing talent in that equation?
Yeah, there's certainly a war for talent, and it's intense, and I think it's a good thing. It's great to see, to see all the demand for talented people. So far, look, there's two sides of it. There's the tech talent that Goldman Investment Banking, my business, finds, and we feel really good about that. We still have this incredible funnel of people coming in from undergraduate and incredible amounts of talent that wants to work at our firm, record numbers of applications. And we have the benefit of being a very, very strong franchise, the leading franchise in the market, so we can get bankers from other platforms who might want to work with us. It's a privileged position to be in, and we like it. On the broader engineering side for the firm, it's not my side of the firm, but I spend time talking to some of the really senior people that we've brought over, these name brands, these incredibly credentialed people that we've had the good fortune to bring over. And I must say, it's a competitive war for talent, so you got to get the package right. You got to offer them a competitive package, but equally, I find, and this is me extrapolating from a narrow slice, but I find that engineers at the most senior levels are focused not just on the package they get, but equally the mission and the difficulty of the problem they're trying to solve. So when you can come to a financial services firm, the size of the financial services industry, the complexity of it, and help to bring more people into the system, change the way the information flows, change the way the data flows, change the way the capital flows, that's a pretty intriguing mission to some of them, and that's how we've been able to get some of these really high-profile names.
So what's the argument to work at Goldman out of college versus Google or an up-and-coming startup where you can work remotely, be with your family?
Yeah.
I know you've got kids.
Yes.
What's the sell to be part of the next generation of Goldman Sachs?
I think Goldman Sachs is the greatest place to start a career and to build a career over time. The network that you meet at Goldman Sachs, the client access that you get and the deals you get to work on, the network of your peers and the network of the people you work with, and the training you get, the analytical training that you get is extraordinary. Now what we want to do, and I think we have a lot of success in convincing people that the people who come into our firm, it's an incredible group. What we really want to focus on is how we keep them for longer, how you have more people stay 29 and a half years over the course of their career, and we're doing a lot to focus on that.
So you have to make a lot of phone calls to all of the new recruits.
I'm happy to.
All right, Dan Dees, thank you so much for joining us. Great to have you today.
It's great to have you here, Emily. Thank you very much.